Hi everybody, Russell here from VectorVest. This week I want to speak about GameStop. GameStop, it's a brick and mortar store in the US. The reason I'm bringing it up this week is no doubt you would have seen many an article and discussion point on GameStop. So I want to drill into VectorVest, where VectorVest could give us some pointers as to what the likely outcome would be in the long run. Now, just to cut to the chase, just to summarize it up quickly, what happened is Melvin Capital, a big hedge fund, had naked shorted around about 140% of the available stock of GameStop. And they were betting on GameStop dropping in price. Why? Because GameStop is a brick and mortar type store selling software, computer software, gaming software, much like the DVD stores of yesteryear. A lot of them went bankrupt. You don't really see DVD stores anymore. Everybody gets things online now, right? So you get your movies via Amazon or Netflix and the likes. Same with computer gaming now. You don't really go into a brick and mortar store. You go online and you're then able to download your software and install your games, and away you go. As it turned out, Melvin Capital saw that opportunity. This company doesn't look very strong. We're going to bet on it going down. Fair enough call at the time. But what happened is that Melvin Capital bet 140%, close to 140% of the available stock via a naked short. As it turned out, there was a discussion blog forum on Reddit, so it's like a blogging type website called Wall Street Bets, and a couple of astute investors picked up the fact that Melvin Capital was shorting a huge amount, one of the biggest amounts in quite some time of a given stock. And they decided to drive the share price of the stock up, knowing full well that the hedge funds would have to cover their short positions. As such, they caused what is called a short squeeze. So the hedge funds were scrambling to cover their short positions. So we're having to buy the stock to cover their short position to net it out. So if you're shorting a stock to net it out, you need to buy it to close out the position. So let's do this. Let's go and have a quick look in VectorVest here. So graphs. So GameStop, so if you want to just type in game, for example, then there we are. It gives you a ticker code, GME. All right, I've got a few indicators on here, so let's just turn these off for now. And let's go back and relive what took place. So you can see over here, this is where the Reddit type forum was starting to pick up the fact that there were a lot of shorts on offer. I'll just close out here for now. So a lot of naked shorts taking place by the hedge funds, and a lot of people started to pile in and buy the stock, and as it turned out, up and up and up it went. Just to give you an appreciation for the scale here, if you look at the price, there it was, $60 odd. Look at that high point there of $340 odd. So you can see, and if you go back a little bit prior in time, $17 odd. So this was a significant pump in the share price. This was all the short covering taking place. What often happens with short squeezes is that they are short-lived. The reason being is because all the shorts eventually get covered, and then the share price drops back down to what its fair value should be. If I put in the value over here, and let's just change the style, just make it a slightly different color for us to see here. So let's make it stand out a bit more, and I'll just, let's say, make it go red. Okay, so you can see over here that VectorVest, you can see on the value here, $4.41. If I pull it back just a wee bit over here, you can see it hasn't really sort of changed too much over time. So it's been around about that $4 odd. So if you were going to go in here hoping that the short squeeze was going to continue, you'd have to be very careful because the value ran about $4 odd. So once the short positions were closed out, no doubt that the share was going to come crashing back down to earth. Now, just out of interest, when this was taking place, I said to myself, wow, this is most likely going to go and fall right back down to its true value, around about $4 or $5. Time will tell. It's back down to about 90 now as of time recording here. So it closed in at $90 odd on the 2nd of February. Wouldn't be surprised to see it go quite a bit lower. Time will tell. One such strategy that you could have considered. Now again, what I'm going to note here, this is high risk. Okay, when a short squeeze like this takes place, anything can take place. We don't know how many short positions are still outstanding. It's high risk because maybe there's still a lot of short positions still outstanding, and this thing could have continued to spike upward quite a bit more. But we all know at some point, once the short squeeze is over, the price will have to return back down to what the market value is, typically around about there somewhere. So one such strategy could have been that you could have bought a put or two of contracts. So one contract controls 100 shares, you might have bought one or two puts, and you could have held on to those puts, put the expiration dates out 2 or 3 months, so you've got plenty of time, and put the strike price of the put as close as possible to the current share price. So for example, on that particular given day, share price closed at 347. You could have gone and bought a put contract close to around about 347 for the strike price. Let's call it, let's say 340, 3 months out. And as the share price continues to fall, the value of the put continues to rise in value. And those put contracts taken out at that point in time over here would have been worth a lot of money. But again, very high risk because we don't really know the nature of that squeeze. Maybe all the short positions are not fully closed out just yet, and this could surge back up again. Time will tell. All right, so this is certainly not for the faint-hearted. If you were to do any such type strategy, you certainly are taking on high risk, and you certainly would not want to invest more than what you could afford to lose. The reason why I bring this up is because unfortunately quite a few investors out there in the marketplace got caught up in the euphoria, and they invested large amounts of money betting that the price would go higher in value. But those betting that the short squeeze would continue to power up have lost a bit of money. So a lot of money in some cases. So the takeaway behind all of this is decide on your risk profile. This was a high risk profile type investment. All right. Plenty of articles out there on the internet warned. They said, be careful, this is highly risky. If you are going to invest in some put contracts or invest into some call contracts, you might have put a call option or just simply bought the share hoping the price was going to go up, betting on the fact it was going to go up. Only invest what you can afford to lose. Now, at this point in time, when it spiked up around about here, I looked at it and thought to myself, wow, this thing's either going to power up further or it's going to come crashing back down. I went in and I had a look at the puts. Puts were incredibly expensive. All right, so at that point in time there, I decided no, I was going to be risking far too much. If I did want to take the chance that the short squeeze would continue, I could have gone and bought 1 or 2 or 3 odd shares for argument's sake. But the key takeaway there is apply the 1% rule. Never risk more than 1% of your total investable capital per trade, as we teach at VectorVest. Right, that's what we note. So if you had $100,000 to invest, what's the most you could lose on 1% using the 1% rule? It would be $1,000. So what you could have done is you could have said, well, I've got $100,000 to invest. I'm not going to invest more than $1,000 in GME, and I might buy 1 or 2 shares long. And if they go to $0, then so be it. I've only lost 1% of my investable capital. That's one way you could have done it. Another way you could have done it is to say, right, I've got $100,000. If I invest $10,000, then I need to apply 10% stop loss. And if the 10% stop loss is triggered, I lose $1,000. 1,000 of 100,000 is only 1%. All right, so the lesson behind this, be careful about being caught up by euphoria, right? Lots and lots of articles, lots and lots of bullish predictions that the short squeeze has only just begun and this could go to $2,000, $3,000, $4,000 a share. Quick jump, and now all your risk losing out on a small fortune. Be careful. Don't fall for those types of strategies. Use your common sense. Use the 1% rule. Now, in fairness to Melbourne Capital, I could see the rationale behind shorting. Earnings, you can see that earnings have been quite anemic for quite some time. Brick and mortar stores are under a lot of pressure, as we know, due to coronavirus and other such market conditions out there. A lot of the world's now going to a digital type world. A lot of things are being acquired online rather than in brick and mortar type stores. All right, so you've got that as a backdrop. So fair enough, the earnings were starting to fall. If I had a look at the earnings growth rate here, Earnings growth rate's been negative for quite some time over the last 2 years. So look at that number, negative 6%. So it's been negative for quite some time. In addition, I can see if I look at the sales taking place, sales was really sort of being hammered, falling off quite dramatically there. And net profit margin has been negative for quite some time. So this is a company, forget the share price for now, but looking at the fundamentals, this is a company that's got a fair few fundamental issues behind it. Sales falling, net profit margin negative, earnings declining. It's not a particularly strong company, right, by any stretch of the imagination. So you can see the rationale for shorting it. However, this is where you can become your own fund manager. Would you have been comfortable, if you could, to have naked shorted 140% of a given company? All right, that's a big bet. And if it goes against you, you can lose big. All right, so again, you've got the power using VectorVest to be your own fund manager. I certainly would not have had the stomach to short 140%. Could I have done that? So just in closing here, use the 1% rule. Don't risk more than what you can afford to lose when applying your stop loss criteria. That's what we know to VectorVest. 1% rule works very well. Don't risk more than 1% of your total investable capital per trade. So if you wanted to go ahead and short a company like GameStop, apply your 1% rule. If it didn't work out, you live to fight another day. Don't make the mistake that the hedge funds made by taking on too much risk and ending up with a 50-odd% loss for a given month. Until next week, hope you enjoy this. Bye for now.